We are looking at a global economy that has definitively fractured. The post-Cold War era of cooperative multilateralism is over, replaced by a competing transactional order. Sovereign states now operate in a reality of multipolarity without multilateralism. Traditional institutions like the World Trade Organization have been sidelined by aggressive bilateral deals. State actors are deploying raw materials, data center permits, and cross-border payment systems as direct tools of geo-economic confrontation. This chart shows the traditional 60-40 portfolio, 60% equities and 40% bonds. In this volatile environment, passive allocation shatters. It is a fatal vulnerability. To survive, capital must be restructured into a multi-layered, reinforced defense. Wealth managers are abandoning passive public indices. Instead, they are actively reverse engineering their portfolios to withstand state-led industrial policy and rising sovereign debt. Global capital allocators are transitioning to national security investing. Elevated geopolitical risk premiums are now a permanent feature of asset prices, requiring a strict departure from legacy wealth preservation strategies. To build this insulated portfolio, we have to reevaluate where global growth actually comes from. The momentum has physically relocated, driven by shifting demographic and productive trends. In 2026, the BRICS Plus coalition represents nearly half of the global population and has officially surpassed legacy Western economies in purchasing power parity, or PPP. PPP is a metric that adjusts gross domestic product to reflect the actual cost of living and goods within those specific countries. The G7 economies, by contrast, are stalling under the weight of mature markets, rapidly aging populations, and suffocating debt-to-GDP ratios. This data table shows 2026 real GDP growth projections. The growth divergence between these two blocks is widening aggressively, with BRICS Plus averaging 3.7% against the G7's 1.1%. The contrast is starkest at the individual country level, where India is projecting 6.2% growth, while Germany struggles to hit 0.9%. While the G7 still holds nominal superiority in financial market depth, the Global South is rapidly accumulating productive capacity superiority. Allocators are responding by rotating aggressively into emerging market equities and debt, positioning themselves to capture the upside of technological leapfrogging and internal trade networks. Clinging to a home bias in G7 markets exposes a portfolio to mature, idiosyncratic sector risks. Capital must migrate to where the actual industrial growth engine resides. Economic data only tells part of the story. We also have to account for acute physical constraints, where kinetic events instantly create nonlinear shocks across global markets. The most severe supply disruption of 2026 occurred in late February, when Iran executed a near-total closure of the Strait of Hormuz, blocking 20% of the world's daily oil. This chart tracks Brent crude prices. The market reaction to the closure was instantaneous, pushing oil violently past $126 per barrel. This energy shock compounded an existing global logistics crisis. Extreme weather and rerouted commercial ships reduced maritime slack capacity to near zero, triggering infrastructure collapse. Maritime insurers responded by issuing area expansions and hiking premiums, creating uncontrollable procurement uncertainty for Western manufacturing. This oil inflation transmission mechanism actively compresses profit margins across the S&P 500, draining equity valuations. To counter this, the insulated portfolio utilizes heavy infrastructure and energy debt. These private assets act as a predictable, inflation-linked stabilizing sleeve. Passive equity is defenseless against physical choke points. Only energy infrastructure and hard assets provide a functional hedge against structural cost volatility. That volatility extends directly into fixed income markets. Expansionary government spending has broken the traditional stability of public bonds. This chart illustrates the primary source of global sovereign risk. The unanchored U.S. fiscal deficit consistently runs at 7 to 8% of GDP, forcing underlying term risk premia to steepen. Without a credible plan to reduce this deficit, U.S. Treasury markets are highly vulnerable to disorderly sell-offs. Meanwhile, the Global South faces the adaptation trap. Extreme weather events raise borrowing costs, which prevents countries from investing in climate resilience, ultimately triggering sovereign downgrades. The search for durable yield has pushed institutional capital out of public bonds and into the private sphere, exploding private credit into a $1.9 trillion ecosystem. Within this ecosystem, the primary target is asset-based finance, or ABF. As traditional banks retreat, ABF steps in to provide direct, secured funding for large-cap corporations. To manage the hidden 5% true default rate lurking within private credit, wealth managers use secondary investments, buying existing fund commitments to secure shorter durations and better entry points. Legacy sovereign debt is now a source of volatility rather than a safe haven. Illiquid private credit has become the mandatory anchor for portfolio yield. Technology value chains are no longer viewed as commercial enterprises. They are highly protected national critical infrastructure. The United States is enforcing techno-nationalism, using preferential trade access to force the reshoring of midstream semiconductor fabrication. This has secured over $1.4 trillion in domestic ecosystem investments. This hardware is required for the evolutionary leap to agentic AI, autonomous systems capable of reasoning and execution. This shifts global threats from mere information theft to functional, real-world cyber-hacking. But there is a physical bottleneck choking this AI arms race: access to massive amounts of baseline electricity. Data center energy demand is projected to skyrocket by 130% by 2030, sparking localized political backlashes over rising electricity costs and land usage. Allocators are pivoting. They are abandoning overvalued software plays in favor of strategic hardware, specifically grid infrastructure and long-duration storage. Investing in AI no longer means buying algorithms. It requires buying the raw energy generation and cyber defense perimeters necessary to operate them. When managing tail risk, we have to analyze how capital actually behaved under acute stress, specifically during the 16-day window of the 2026 Iran war. Gold experienced a traditional rotation failure, dropping 2.0% during the physical supply shock. The asset that completely decoupled from traditional risk behaviors was Bitcoin, surging 7.0% in the exact same timeframe. The structural reason for this decoupling is ownership. The asset base has shifted from retail speculators to institutional spot ETFs, which now manage over $140 billion. Over just 3 sessions, a massive $1.1 billion inflow into U.S. ETFs effectively absorbed and neutralized retail panic selling. 24/7 tradability proved paramount. It allowed real-time capital repricing of weekend geopolitical shocks when traditional fiat markets were closed. The digital gold narrative has moved from a niche theory to a structural necessity. It provides active wealth preservation against inevitable fiat debasement. This diagram shows the fully populated architecture of the strategic insulation portfolio. To secure these assets, we apply defensive perimeters. That outermost ring addresses the final critical layer of defense, mitigating the severe threat of home bias exposure. Investors must hold assets outside their domestic legal frameworks, utilizing politically neutral hubs like Switzerland and defensive currencies like the Swiss franc. Legacy investors remain exposed to a highly concentrated S&P 500, weight down razor-thin margin for error, and an unrealistic 14 to 16% EPS hurdle rate. The era of passive index investing is dead. Survival in a transactional world belongs